24 hours, we've heard from the head of the U.S. Federal Reserve, Jay Powell, staying committed, singing that same song on support for the economy until we see a real improvement in the jobs market. So we'll watch to see how the market ultimately reacts to this, but the initial reaction was a negative one. And I want to get some instant reaction to all of this now from Frances Donald, who tracks the economy over at Manulife and joins us now with her reaction. She's the chief economist and head of macro strategy with Manulife Investment Management. Let's just start with the headline number, Frances, of a stronger than expected jobs report and your reaction to that.
My initial reaction is to just glance at my screen and see that the 10-year yield in the U.S. is now over 160. And as you pointed out, futures don't like it. So, the Economist segment of my job says, thank goodness, great number. We're seeing some healing. But the strategist part of my job says this is only reinforcing the Fed's laissez-faire attitude about higher yields and is probably going to be pinching risk a little bit more on an ongoing basis. For so long, we would say bad news is good news because it means more stimulus. We might be transitioning into an environment where actually good news is bad news for the market because it means we're going to have those higher rates as we face things forward. And this massive punch bowl of stimulus might not actually be as available to us on an ongoing basis. So, let's get into the details. Let's talk about what it means for the economy, which is universally positive. But as we learned in 2020, what it means for the economy is not always what it means for markets and what we're doing with our portfolios.
And Frances, I'm happy to keep the conversation going on what you just said because it gets a little bit confusing for people. But just to reiterate, we've got a stronger than expected jobs number. You've got a very accommodative U.S. Federal Reserve. You talked about the reaction to this data in both the stock market and the bond market. And it's the bond market's growing belief that because we have seen low rates and a lot of stimulus from the Fed and improvements in the economy, that things may be overheat and that could put pressure on the Fed to raise rates. And then yesterday, Jay Powell basically said, I'm going to keep doing what I'm doing. Talk to us about why this concern of overheating is growing. What are the dynamics at play here right now?
Well, actually, I'm not so sure it's concerns of overheating. It's trying to get a sense of what the Fed's reaction function is. So a lot of people say to me, what's the level of the 10-year that actually bites on equities? But we spend a lot of time looking under the hood at what's actually being priced into the market. And it's really important to see, are yields moving higher because of more growth or because they expect more inflation or because of both? What we've noticed in the past 2 weeks in particular is when that 10-year rose to about 130, that was better growth being priced into the story. But from that level on, things started to change and the underlying dynamics are a little bit more nefarious. Now the market is not necessarily pricing in the better outlook, the reflation trade, because those break-evens have been very stagnant. They're actually saying the Fed's reaction is going to change and they're going to pull accommodation as early as 2022. That changes the way we have to value stocks. So the big picture here is that for a long time in the past year, we've said extraordinarily low rates. There's no place to be but equities. You cannot generate enough return in your portfolios with bonds in that type of environment. But if we're in an environment where rates are going back up, that changes that asset allocation decision just a little bit. We're a long way from critical levels, John. I don't want to say now is the moment to make these drastic changes. Absolutely not. But those levels are starting to creep up. It's not a level, it's a direction that we need to be monitoring.
Well, all along it feels during this pandemic and this unusual stretch we are living through, historic really, the stock market and Main Street aren't always, dancing to the same Dua Lipa song. The improvements we're seeing right now on the jobs front, I mean, the average monthly gain for the U.S. economy since November had been, I want to say 29,000 jobs, because, we saw it here in Canada, right? We saw an encouraging summer period, and then, COVID cases are on the rise, so we have to see lockdowns and restrictions, so some of the momentum was gone. Now that we're talking about revised January numbers in the U.S., the better than expected February numbers, and that news on the vaccine rollout in the United States, Joe Biden with that big announcement this week, right, that by May, as opposed to, say, by the summer, that vaccines hopefully will be available to all Americans who want them. Can you just paint a picture on the actual economic recovery in the U.S. and maybe how that compares to us here in Canada?
So I think you actually did a great job, Don. Those are all the good news stories that mean we're heading towards a much better second half of the year. But I have two caveats here. The first one is that this is all the good news we already know. This is the good news that propelled the stock market higher to these levels, that helped lift rates up until about the 130 level in a very comfortable manner. What we need to be aware of right now is that a lot of the good news is priced, and there might be some downside news that we should be aware of. The fundamental story, though, doing much better. The second part of the story that is really worth underlying is that while the economy and markets are disconnected and the market is looking towards the second half of the year and all of this good news, the U.S. economy is still in a very dire strait with employment. We are still looking at almost 20 million Americans who are on some form of assistance, and 12 million Americans are on forms of assistance that will expire in March. We are looking at almost 40% of those who have been unemployed longer than 27 weeks. That type of damage to the economy doesn't reverse itself by May, even if we have lasting vaccines that come through. It takes time to see that healing. So yes, we are seeing a lot of good news. We are going to see this U.S. economy recover. We are going to see the Canadian economy recover. But are we going back to a pre-COVID economy by the summertime? No, we are going to see some lasting damage. We're going to require policy support through this environment. And we should be aware that it's not going to be a straight line higher in improvement. There's going to be some bumps in the road.
Kind of amazing. I'm looking at the data too, Francis, and it appears that leisure and hospitality, two areas of the economy that have been absolutely crushed during the pandemic, seem to add in the neighborhood of 355,000 jobs in February. You know, I know you're watching that part of the Canadian economy as well right now. How difficult is it to forecast the return of those kind of jobs, given the unknowns with the virus itself?
Here's why it's difficult, John, because the return of leisure or services jobs or restaurant jobs just depends on when lockdowns lift. And lockdowns depend on vaccines, variants, and everything medical, not what my GDP forecast is, not what fiscal or monetary authorities will do. So I think BNN asked me this week, do we need more monetary and fiscal stimulus? What we need is vaccines. And that's why it's so hard. This is why you have huge variations in economists' forecasts, even in the United States, because the economic outlook still depends on the medical outlook. And, you know, I went to school. The last time I took a science class was grade 9. I don't know how to forecast that stuff. We can just look at data. We're still in a very complicated COVID-like economy. We're not out of the woods yet on that. We need vaccines.
I think I made a shift out of science even earlier than that. Hey, Francis, before I let you go, and just for those who are tuning in right now, we saw a much better than expected jobs report in February in the U.S., revised positive numbers for January. The market's still trying to figure out what they think about this, given everything Francis talked about. And I should note that average weekly hours were down in February. So even if people are getting jobs, it's not like there is a massive amount of work to be had until we get back to normal times. But we talked earlier in the program with Mike McKee of Bloomberg about what Jay Powell did say yesterday, which is that he doesn't want to see disorderly moves in the markets. Looking at this reaction this morning, is this normal reaction? Are we kind of moving towards disorderly reactions in the market?
Disorderly will be about speed. I would say, you know, 5 basis points higher on the 10-year is not disorderly. They're also probably not talking about a single day. Make sure that, you know, when we think about disorderly, we're also talking about some of the underlying plumbing in the system, things that don't come up on our regular headlines. Things like last week, there was a failed U.S. Treasury auction for the 7-year, very weak auction, these types of problems. There's a lot of plumbing at the Federal Reserve. They're looking at whether or not they're going to extend permissions for banks to hold less leverage against U.S. Treasuries. That's creating a little bit of disincentives for buyers of Treasuries within banks. This is not as simple as the economy and rates. The Fed is trying to manipulate a whole system and allow that financial repression to come undone. It is not going to be orderly by its very nature. And the Fed is communicating to us it's okay with a little bit of disorder. What it doesn't want to see is massive spikes, big moves in real rates in particular, and certainly not any type of accidents that happen under the surface of the market.
Top-notch insight and analysis as always, Francis. Hey, thanks for helping us break down these important numbers on this Friday morning. Francis Donald, Chief Economist and Head of Macro Strategy at Manulife Investment Management, joining us.